Another Fed meeting resulted in yet another rate hike, the 10th consecutive rate hike, that is. There are many sectors out there that react negatively to rate hikes, but none worse than the REIT sector. REITs rely a lot on debt, and after all, their structure forces them to pay out at least 90% of their taxable income back to shareholders in the form of dividends. This is one reason that REITs often have higher yields. 10 straight rate hikes, though, is unprecedented, and it has created deep value opportunities for long-term investors, especially those looking for real estate exposure. And in today's video, we are going to take a look at 3 REITs that are trading at great valuations in the month of May. So if you're excited about today's video and you love REITs, do me a huge favor and click that like button down below, subscribe to the channel, and let's get started. Hey everyone, Mark Rushin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice, and please perform your own due diligence before investing in any stock or ETF mentioned in today's video. And before we get started today, let me take a quick moment to thank today's sponsor, which is Moomoo. Moomoo is a great platform with tools for investors of all different levels. Right now, we are in the thick of earnings season, and right now on Moomoo, you can see the earnings calendar, which can be very useful to see what companies are reporting earnings that week. You can find this by going to the Markets tab down on the bottom, and then you'll see Explore. From there, you'll see the earnings section right there in the middle, which will show you the company's earnings by day. And right now, new users that open an account using my link down in the description below can receive up to 20 free stocks. You'll receive 1 just for signing up for an account, another 9 stocks for depositing up to $100, and the remaining 10 by depositing $1,000 into your Moomoo account. Make sure you see the link down in the description below. Now let's get back to the video where we will be discussing 3 of the top REITs that you can buy in the month of May. Let's begin with Global Medical REIT, which is stock ticker GMRE. This is a much smaller REIT than compared to the other 2 we're going to look at today, as they have a market cap slightly below $600 million. Over the past 12 months, GMRE is down over 30%, and year to date, the stock is down roughly 6.5%. GMRE has a very high dividend yield of nearly 9.5%. For those of you unaware, GMRE is a medical office REIT. They own buildings such as medical office buildings. They also have rehab facilities and other specialized facilities within the medical realm. Global Medical recently reported their Q1 earnings, which saw FFO come in line as they reported 23 cents per share of FFO, and revenues came in at $36.23 million, which slightly missed analysts' expectation by $0.34 million, or $340,000. Increased total revenue of nearly 14%, which was primarily driven by company acquisitions over the past 12 months. The company increased their portfolio occupancy rate from 96.5% at the end of 2022, so Q4 2022, to 97% as of the end of Q1. Next, let's take a look at the company's portfolio summary. As you can see here, the company has 188 total buildings within their portfolio, which equates to nearly $5 million of square feet. They have a total of 274 tenants, and as we already saw, they had a 97% occupancy rate as of the end of Q1. In totality, total annual base rent, or ABR, equates to nearly $115 million. In terms of lease terms, when GMRE leases out to their tenants, we're seeing a weighted average lease term of roughly 6 years. And the weighted average rent escalators, these are built in already to the lease terms, is roughly 2.1%. Now let's take a closer look at asset type. As you can see here, 68% of the company's annual base rent is made up of MOB, or medical office buildings. The other 18% is IRF, which is more the rehab facilities. Another 6% is surgical hospital, and the remaining 8% is other types of properties. You can see in terms of location by ABR, Texas is going to be the largest, with accounting for 18% of total ABR, followed by Florida, and then you can see a whole mix of other states with where they have a presence. One thing to note here, looking down at the lease expiration schedule, you can see that nearly 14% of the company's ABR is coming due here in 2024. So these are going to be tenants that have expirations that are coming in the next year. What this means is it gives an opportunity, because if we go back, a lot of these leases took place in 2017 or 2018. So they're coming due here, which means there's an opportunity to increase those rents, bring them up to market, which could be a tailwind, assuming that these tenants re-up their leases for another 6+ years. So now that we know a little bit more about Global Medical REIT, let's take a closer look at valuation. Here, looking at this fast graphs chart, you can see the blue line is going to equate to, this is more the average AFFO over the past 7 years, or over the past 5 years, I should say. And you can see where GMRE is trading right now at a price to AFFO in the single digits, close to 9.1 times. And if we move over here, you can see that over the past 5 years, GMRE has traded closer to an average of 14.7 times, creating big opportunity for those of you that are long-term investors. There's going to be a little bit of volatility still with interest rates continuing to rise, but it appears like we are at the end of this rate hike cycle. The next stock on our list is Realty Income, stock ticker O. Realty Income is also known as the monthly dividend company, as they pay out their annual dividend on a monthly basis. And right now, speaking of that dividend, they are yielding close to 5%. And I say anytime Realty Income trades with a dividend yield above 5%, that has proven to be a great time to add shares. We were there, but the stock has climbed a little bit higher over the past week, just to nudge it a little bit below that 5% threshold. Over the past year, shares of O are down roughly 4%, and year to date, Realty Income is down 2.5%. The company recently reported their Q1 earnings, which saw FFO of $1.04, which beat analyst expectations by 3 cents per share. Revenue came in at $944 million, which also beat on analyst expectations by $61 million. So really a solid top line beat there for Realty Income. They ended the quarter owning 12,492 properties, which were leased out to nearly 1,260 different tenants. In addition to reporting solid Q1 earnings with a beat on both the top and bottom line, Realty Income's management team also increased their full year 2023 guidance. Next, let's take a closer look at Realty Income. As you can see, the company went public in 1994, and since then they've had a compounded annual total return of 14.6%. And in the years that they've been around, those 27 years, they have seen positive earnings per share growth in 26 of the 27 years. The company's median AFFO per share growth since 1996 is 5%. We already looked at the dividend, which is trading slightly below 5%, but the company has also been increasing their dividend each and every year. They are what is considered a dividend aristocrat because they have increased their dividend for 25 consecutive years or more. In fact, looking down here, you can see that Realty Income has increased their dividend for 29 consecutive years and counting. And not only do they increase their dividend on an annual basis, they actually increase their dividend on a quarterly basis, as we have seen over 100 consecutive quarterly dividend increases from Realty Income now. Looking here at the tenant base and the portfolio as a whole, you can see a lot of notable names for Realty Income. The top tenant is Dollar General, which accounts for 4% exposure, followed by Walgreens, 7-Eleven, Dollar Tree, and Wynn rounding out the top 5. Wynn is a new addition, or newer, I should say, addition to the top 5 list or top 10 list, as the company recently entered the gaming sector. Other notable companies that you will find on the top 20 list for Realty Income: CVS, Walmart, Lifetime Fitness, Tractor Supply Company, as well as Lowe's and Kroger. Over here, looking at industry diversification, you can see that 10.2% is related to grocery stores, and convenience stores accounts for 8.7%, followed by dollar stores at 7.3%, rounding out the top 3. In terms of property diversification, retail really takes up the major component of Realty Income portfolio, accounting for 82%, followed by industrial, which accounts for 13.3%, gaming, which I mentioned is new, accounting for almost 3%, and other rounding out the final 2%. Texas and the UK are now the 2 largest in terms of geographic diversification, both accounting for 10.3%. Looking now at valuation, you can see that Realty Income trades at roughly $62, and analysts are looking for 2% AFFO growth, which equates to $4 even for their AFFO in 2023, which lines up with management's expectations as well. And this right now has Realty Income trading at a 2023 AFFO multiple of 15.5 times. If we scroll over here, we can see that over the past 5 years, they've traded closer to 19 times. So you're seeing the value in this high quality dividend paying stock, monthly dividend paying stock with Realty Income. The final REIT we're going to look at today is Simon Property Group, stock ticker SPG. Simon Property Group currently has a market cap of $40.5 billion. They are the largest mall landlord in the US, and over the past 12 months, shares of SPG are down roughly 10%. SPG recently reported their Q1 earnings, which beat on the top line, with revenues coming in at $1.35 billion, beating by $80 million. And FFO came in at $2.74, which missed analyst expectations by 7 cents per share. Domestic property NOI came in at 4% growth, with the portfolio NOI increasing by 3.9%. Occupancy ended the quarter at 94.4%, which was an increase over year when they had 93.3% as of Q1 2022. Another thing to note with Simon Property Group is they have known to pay a high dividend yield, and right now their dividend yield is close to 7%. And during the Q1 earnings, I should mention, the company increased their dividend roughly 9% moving forward. So we're getting 2023 off to a great start with a 9% dividend increase, which is in line really with what they did in 2022. And in 2021, they increased the dividend nearly 30%. SPG also has a high credit rating similar to that of Realty Income that we just looked at. You can see the A-rated credit ratings across the board for the company. Now for NOI, which is a close metric to look at for this mall landlord. You can see that 72% of their NOI comes from malls and premium outlets. They do have an international presence, which comes in at 8.6%. They have a Mills segment coming in at 11.4%, as well as TRG, which was an acquisition they made a few years back, making up 8% of the company's NOI. In terms of geographic location, you can see that Florida is the largest at 18.5%, I should say the single state largest, followed by California at nearly 14% NOI, and then Texas rounding out the top three at 10.4%. Lastly, let's take a look at valuation. With shares of Simon Property Group trading around $106, analysts are looking for AFFO to end 2023 around $10.80, which would be a 1% decrease from 2022. And moving forward, we see that they expect 3% growth in 24 as well as 2% growth in 2025. But honing in on the 2023 AFFO growth, right now the multiple for SPG is at 9.8 times. And if we scroll over here, we can see what the company's 5-year average is, 13 times flat. So that shows you the valuation gap between the two right there. There's going to still be a lot of headwinds for this retailer, for this mall landlord, but they are the best mall landlord. They have A-rated malls across the US, and they also have an international presence. As we just saw there, all three of these REITs are trading at huge discounts to their 5-year averages. You can even move things out even further and look at their 10-year averages, and you will still see all three of these REITs trading at sizable discounts. Realty Income is one of the most well-run and most well-known REITs on the market today, and as we saw, SPG is also the best retail or mall landlord in the US with an international presence. Now, if you're looking for more small cap REITs in the medical, office, healthcare type sector, then take a closer look at GMRE or Global Medical REIT, as although they are smaller in scale, they continue to grow in size, and this is a sector that's really been hit hard. Let me know down in the comments section below which of these three REITs would you be comfortable buying right now. And thanks again for watching the video. If you haven't done so yet, smash that like button, and we'll see you in the next video. Take care.